time. I've got an expensive timepiece here. It's a BlackBerry. I bought it secondhand on Kijiji because I don't like to overpay for things. So my name is Alec McIsaac, and I work with Antares Investment Management. And the purpose of my being here is that my firm, Antares, does one part of the piece here, and that is we take care of the investments. And, you know, my profession tends to be the one that gets the most talk, and, you know, people talk about the investments all the time, but the way we view things is that we are privileged to work with Cooper Financial, with Adrian, because what we do works within a structure. The key to successful investing is not necessarily, the key to successful investing is to have a process and to have a structure. And the structure starts with the financial plan. It starts with having innovative solutions for business owners, and where we come in is we help implement it. That's what our job is, nothing more, nothing less. And one other comment I would make is, as a CFA charter holder, I, like Adrian's firm, I have a fiduciary responsibility. We are portfolio managers in Canada with a fiduciary responsibility. Clients always come first. This is my colleague Ricardo Melo. So my firm is based in Winnipeg, Manitoba. We are 15 people. We're a boutique investment firm. We manage just under $500 million. We've been in existence since 2004. What else can I say about us? Well, we're independent. We're independently owned, and that means a lot to me. I've been in this business since 1997, so I guess that makes it 22 years. I've always worked for independent firms. I've interviewed with larger firms, and in fact, in my previous job, I managed, as was noted, a fair bit of money for a large publicly traded firm. And I can tell you something, working for a small firm as opposed to working for a big firm, they're very different things. We know who the boss is. The boss is our clients. We have direct relationships with our clients, and I think that is part of our value proposition, I think, Carol, to a firm such as yours, because whereas you know, historically the model was to entrust clients' hard-earned money with other professional managers, typically based in Toronto. Nice town, love it, love Toronto, but I really love Liverpool. So tangentially, Liverpool is playing Tottenham Hotspur for the Champions League final on Saturday at noon, and I hear that the Irish Times pub in town here is the place to be. So I'm going to try to make it there with my daughter who lives here. But apparently there's going to be a lineup, so I have a plan B, and that's, what's it called? Penny farthing. So anyway, yeah. End of tangent. Where was I now? So I think part of the value proposition is this. Whereas money was managed by other people, and there are all sorts of intermediaries in between client and money, and clients typically don't know what they own. What we offer is a direct relationship and a partnership with your financial planner, where you have a relationship with at least in as much as you want to as clients with us as portfolio manager, and the transparency of the portfolio is very much there. You know what you own. We talk about what you own, and you can ask us questions about what you own. And a lot of people do ask us questions, and we enjoy the talk. Critically, we eat our own cooking. So our money, our family's money, all of my net worth, aside from my emergency cash stash, is invested in the portfolio that I manage with my colleague. And critically, this is important, and while I don't ever talk about other clients, I'm allowed to talk about one other client. That's my mom and dad, who live in Edmonton. Their money is with me, and mom says, Alec, if this portfolio management thing doesn't work out, I'm moving in. So I can assure you that I'm somewhat motivated. As much as I love my mom, I'm motivated, and I love my mom. I'll leave it at that. So I have a question for you. I have 3 books here, and I'd like to offer these books just as a sort of, I don't know, way of saying you are intelligent, and maybe there's something you'd like to read, and maybe we can talk about it someday. And critically, it has an Antares bookmark in it with a little thingy here that you can clean your phone screen with. So there's a lot of value add here. So my first question for you, and whereas Richard posed the problem of one of taxation, for me as an investor, taxation is a problem, but I think of other problems as well. And one of the problems I think about is that of inflation. I think inflation is the reason we invest. Why take on risk if you don't need to? Well, one of the reasons is because inflation lurks in the background. So, skill testing question. The person who has the closest answer gets the little book of behavioral investing, along with a aforesaid bookmark. Since World War I, what was the average rate of inflation in Canada? Closest guess wins. Anyone want to hazard a guess? 2%. 2%. I hear 2%. Like 2%. Any other guesses? We gotta have a couple. We gotta have a little competition. You want to hazard a guess?
I'll say 3.
3%. Okay. This is like the Price is Right.
Yeah.
A little higher. We have 5. 5%. Who said 5? Okay. We'll take one more bid.
1.5.
I heard 6. Okay. So the closest answer is 3%. I believe it's. We're going to find out when I click the slide. Yeah, the answer is 3.09% annualized from 1915 to 2018. And that's kind of interesting. And this chart shows the different rates of inflation historically in Canada. And I've circled a 20-year period where inflation jumped a fair bit. And that started with the year of my birth, 1967. And I look at it for 20 years during that period. And during that period, the average rate was 7.09%. And many people here in the room will require buying GICs from the bank where they got a heck of a lot more money than is the case today. Conversely, on the liability side of your balance sheets, you may remember, as I do, when Mom and Dad had a variable rate mortgage in 1979 that, shall we say, popped up to 22%. That put the fear of the Lord in Mom and Dad, let me tell you, we have a lot of cat food out here, that's all I have to say. So I bring this up because inflation has been subdued for an extended period of time. And there are debates over what the actual rate is because it includes all sorts of things, but clearly it has been low. Mind you, I would argue it shows up in other areas, for example, real estate in certain parts of Canada. But that being the case, it has been subdued for an extended period of time. The question we ask ourselves as investors, and I think you should ask yourselves as investors, is that likely to be the case going forward? And the answer is, I don't know. Nobody knows. However, odds are, I'd say, it is likely to fluctuate in the future. Who knows, it could get lower, but I think odds are it's likely to be higher at some point. And if it were to be meaningfully higher, that is a risk for everybody, particularly retirees. And I bring this up because inflation erodes purchasing power. So over that 20 years that I was talking about, 67 to 87, what would have got you $100 if you had the same money 20 years later got you $23. So that is what erosion of your purchasing power is. So buying a GIC for the long term or a bond for the long term, while it may have benefits in a portfolio, and our clients do hold these things, doesn't help you keep up with inflation. That's why we have portfolios. Okay, so, yeah, what we have here is a portfolio of bonds, right? Gentlemen prefer bonds. I guess that means, what's that? You're not in the picture, yes, right? I was going to try to do a hack job if you were there, but no, he's a bond. He's a bond, yeah. You know, I guess the point I'm making here, and I say it in the title, is there's security for a cost, and the cost is, in my mind, the risk of lagging inflation. So what do bonds give you? Well, they give you a promise to pay you interest, and they give you a promise to give you your principal back at the end of the day. And the other thing they give you is a measure of stability in a portfolio where other assets may have some volatility. More on that in a moment. Okay. So, what we do at my firm is we invest in bonds, but we invest in equities, and that is where we believe in endeavor to add value to our clients. And this is a very sophisticated chart which shows you exactly how we do it, okay? It's a 3-legged stool or a 3-pronged fork. That's how we do it. We try to keep things simple. We're prairie people, right? We're not Toronto people. With all due respect. All due respect. So, that's right, you're from Quebec. When we think about buying stocks, we don't think about little pieces of paper that ought to be traded frequently. In fact, it's the opposite. We don't want to trade them frequently. We think like business owners. What we want to own is what a stock is. It's a share. It's a share of a business that is ongoing. So as a rational person who is investing for clients who have a time horizon that is longer than 5 minutes, it's longer than a day, it's longer than a month, it's measured in years, I want to own shares of businesses that are successful businesses, are likely to be successful businesses, and I want to pay a reasonable price for them. And so I look for 3 things, just to keep it real simple. The first thing is, I don't want to own a company with too much debt. Where I've gotten in trouble as an investor historically is buying companies that have a little bit too much debt, and you think they can kind of get through it, but they don't. And debt can hurt equity holders. And we learned that in the financial crisis in a very big and painful way. I mean, all of us, everyone in North America learned this. The financial crisis in 2008, we had the failure of very big financial institutions that people wouldn't have believed would have gone broke. Companies that don't carry debt are in a very powerful position when the economy slows down because they can buy their weakened competitors for a cheaper price, right? So you saw Warren Buffett's Berkshire Hathaway lending money to General Electric, to Goldman Sachs, to Bank of America at 10% with a little option to get some shares in the business. So he was using the strong balance sheet of his company, Berkshire Hathaway, to take advantage of weaker companies to increase the earnings power of his company in the future. It's kind of like, you know, Fort McMurray, you lose your job in the oil patch, your neighbor has a lot of debt, and you can buy their skidoo for a very cheap price. Do you know what a skidoo is? Okay, all right. Pickup truck, very cheap price. It's not unlike that in investment. So we don't like companies that have that carry a lot of debt. Secondly, we want companies that have consistent profits. It's another way of saying we want companies that are profitable. So we're not looking for speculative companies out there. If you ask me what I think about cannabis stocks, I'm going to say I have no idea because they don't make money. So what I think is they don't make money, and I'm not going to waste my precious time on them because there's a lot of other opportunities out there. I just don't need to spend time on that. If you want to own that type of thing, I will neither encourage nor discourage you. I might sort of turn my head and go tut, tut, tut. But, you know, some will win and others will lose, and we don't know who they are right now. And as a fiduciary of client capital, I am not willing to invest in something that has a binary outcome, one side of the binary outcome being a very, very poor result. So, consistent profits are critical because that allows for dividends and dividend increases, etc. And thirdly, we want to pay a fair price for this business. You can buy a great business, but if you don't buy it for the right price, you're not going to get a good return on your investment. So we like to be a little Scottish in the price we pay for our businesses. Is that technical enough for you? All right. So let's just talk about 3 example holdings in our portfolio. The first one I'm talking about is Johnson & Johnson. And this little chart here shows how the dividend has gone up year after year despite all kinds of negative stuff out there in the media. And there's negative stuff out there right now on Johnson & Johnson, by the way. But there was the savings and loan crisis, the tech bubble, the tech collapse, there was SARS, there was 9/11, and each and every year Johnson & Johnson raised its dividend. So, for number 2 book, skill testing question. This chart goes back to 1991. But it in fact does not go back as far as it could to show annual dividend increases at Johnson & Johnson. So Johnson & Johnson has raised its dividend longer than this period. When was the last year that Johnson & Johnson paid a dividend but did not raise it? When was the last year they paid a dividend but did not raise it? And the prize here is a book called Where Are the Customers' Yachts, which is a classic on investing. Thin, easy to read. It's great stories from New York in the 20s or 30s or something like that. written by, you can't make this up, Fred Schwed Jr. Fred Schwed, okay? Okay. Alec Schmalek. Okay. So, when was the last year they did not raise the dividend?
I'll say 1970.
1970, okay? Other guesses?
Never.
Never. Any other guesses?
1982.
1982, and one more.
1960.
1960. You are the next contestant on The Price is Right. The last time they did not raise a dividend was 1962. In other words, since 1963, each and every year, Johnson & Johnson has raised its dividend. So that's when JFK was shot. That's when the Beatles came out with Please Please Me. It was when I was just a gleam in my father's eye. Okay, next. And you know, let's just say something about how is it that they can raise the dividend each and every year? Well, they sell things like Band-Aids. So when my daughter scrapes her knee on the sidewalk and there's an economic recession, am I gonna put a Band-Aid on her knee? Yeah, I'm gonna buy Band-Aids. And if I have a prescription to one of the drugs that they sell, am I gonna sort of cheap out and not buy it because it's a recession? Or if I have a stent, do you think I'm gonna like not bother with the stent until the economy recovers again? They sell stuff that people need and they keep on buying irrespective of the economic cycle. And they manage their debt prudently. In fact, their bonds are AAA rated. Their bonds are rated higher than that of the US government, which was downgraded a few years ago. So companies like this help increase inflation fighting power. That's why we own it on behalf of our clients. Example number 2, Accenture. And the purpose of this example is to just say that we like to invest in companies that have tailwinds blowing behind them. So Accenture is a company that essentially does IT outsourcing. So if you're a company like, I'm going to make this up, Johnson & Johnson, and you've got, I don't know how many employees, 50,000 employees all over the world, and you've got servers everywhere, and you say, you know, we want to move our stuff to the cloud. So do you think there's any implications of getting that wrong? No? Yes. Terrible implications. So Johnson & Johnson will go to Accenture and say, we want to move our servers to the cloud. And Accenture sort of says, okay, that's going to take 10 years. We're going to model it out for you. We're going to help you do it, and you're going to pay us a big fat fee. And Johnson & Johnson is going to find that they're going to pay them for the 10 years, and they're going to say, you know, the risk of not using Accenture in year 11 and year 12 and year 13 is very high. So we're going to keep on paying Accenture. So Accenture has tailwinds blowing behind them because businesses all over the world are moving to the cloud. I'm simplifying things, but that's a tailwind. I'll juxtapose that with a headwind. A headwind is your local bricks and mortar, Sears, for example, right? The headwind they face is the shift to online shopping. These are businesses that just, the wind is blowing against them. It's very tough to compete in an Amazon-dominated world. Accenture is the opposite. And what I show you here is the compound growth rate of their sales. Sales tend to go up almost every year. And I circle the financial crisis when it seemed as though the world was going to end. Well, their sales dropped 7.7%. Any business owners here would you consider that a sort of worst year in the history of investments if your sales went down 7.7%? It's not that bad. And what it speaks to is the consistency of the product offering, the high demand for what they do, and indeed the tailwinds. So this is another example of the type of company that we want to own for a very long period of time. We don't want to trade in and out of it. We want to own it like business owners, because companies like this compound wealth massively over time, and they raise their dividends every year. It's good for income people, and it's good for people who just want to grow their capital. Last example, and I did this for you, Carol, because Carol loves to talk about my Subaru. So, again, it's a tangent. You really don't care what I tell you anyway, because I've got a captive audience here. So, I live in Wolseley, which is the crunchy granola neighborhood of Winnipeg. It's just like Victoria, okay? People walking around, there's a Birkenstock store, and there are 2 organic bakeries. And I live there, and they think I'm a fat cat capitalist, right? Then I go to my work in my office tower, and they think I'm the hippie, cannabis-smoking, socialist kind of guy. So I don't fit in anywhere, and I drive a Subaru. Anyway, so Subaru is another portfolio company we own. And have you noticed none of these are Canadian so far? We do own Canadian companies, by the way, but we take a global look on investing because Canada is a very small part of the world. Great companies are all over the place, and most of the great companies, frankly, are not in Canada. Subaru, I would say, is a good to great company in a very tough business, which is autos, which is highly competitive. You see discounts all the time from auto vendors. They all build too many cars and then have to sell them for a cheap price. And the auto sector historically has not been a very profitable business. In fact, 2 of the big 3 companies in Detroit had to be bailed out in the aforementioned financial crisis. Subaru consistently punches above its weight. And the reason, there's a couple of reasons. One is they make very good vehicles. They have high loyalty rates among young professionals in certain demographics. And the third reason is they don't make too many cars. So when it comes time to offering rebates and discounts, yeah, you'll see something in the newspaper from a Subaru dealership, but they reduce way less than the competitors. And as a result, as this illustrates, their average return on capital, which is a profit measure, so high is good, low is not good, has been almost 12% since the credit crisis, compared to under 4% for BMW, close to 3% for Volkswagen, 3% for Honda, closer to 3 to 2% for Toyota, and 2% for Ford. So all of these global companies, many of them the Germans, you know, Subaru is consistently more profitable for them. They're very cheap. They have more cash than debt on the balance sheet, so they meet the criteria of the stool, and that's why we own it. So those are 3 examples for you to chew on. Our portfolios are focused, and a focused portfolio is one that holds a small number of companies in it. And there are different views on how one should invest. One view is a person should own, an investor should own a whole big number of companies because you don't want to put too many eggs in one basket. That is a view that we respectfully but with high conviction disagree with. The best investors of the world own meaningful positions in great companies. By owning meaningful positions in great companies, you do your work on the great companies and you don't dilute your holdings as a business owner in the small companies. Anyone in the room who is or knows business owners knows that a significant portion of your or their own net worth is in their business, and when your eye is on the ball, the probability of success is a lot higher than when your eye is on 500 or 100 balls. So we focus on high quality businesses, and we believe that investors are much more likely to protect their capital on the downside and grow it at a very attractive rate through a focused portfolio. So my last question for the final book is, and this book is Shoe Dog, which is written about Phil Knight, the founder of Nike. And I have not read this book. I've read the other 2. I was recently in Omaha, Nebraska to listen to Warren Buffett and his ilk, and there's a whole lot of smart investors down there, and a number of them are recommending this book. So I bought it for myself. I haven't had time to read it, but if they're recommending it, it's worth it, and I think it's probably just a good read for anybody. So hence this choice. So my question for you is, and no looking on your phones, what is the rent of Boardwalk when you've got a hotel on it in the game of Monopoly?
1140.
1140? 900? 500? 1,000? 1,200? 2,000? $2,000. Oh, did he say 2? I didn't hear that. I'm sorry. Well, I apologize. Yeah. Okay. So the reason I put Monopoly here is because as part of our portfolio offering of stocks and bonds, we also have a relationship with with a manager of real estate. And real estate can play an important diversifying role in the portfolio. What it can do is it can smooth some of the ups and downs of some of the other investments. It behaves differently from stocks and bonds, and it can offer an attractive yield as well. So we think for some clients, not all, but for some, who have a long-term time horizon, this can be a nice complement within the portfolio of investments that we manage directly. And one of the things we like about this manager, they've got a 20-year track record, but their approach to doing this is to buy, fix, and sell. So they buy somewhat undervalued properties on good corners that haven't been managed properly, and they fix them, and then they sell them for a profit while collecting some rent. So I mentioned Boardwalk because Boardwalk, despite its allure on the monopoly board, is not the best investment probability-wise if you're going to play the game of Monopoly. The better investments are somewhere in the middle where the property is cheaper, there's a higher probability of landing on them. So as you know, location matters a great deal in real estate. It matters a lot in Monopoly as well. And just a little, if we're ever playing Monopoly, I always try to buy these ones here. They're really cheap. But if you get hotels on them, they're about $500 to $600. But you get people as soon as they pass go and collect $200. So before they can allocate their money into something, you collect rent from them, and I tend to win a Monopoly. So just pass that on. Love the place. In summary, we value our relationship with Cooper Financial very much, and it works because we have a collaborative approach with other professionals. We're not at loggerheads. We work together for our clients. Second, for clients who care about this, they can have direct contact with their